Picture this. It's February 2025, and while most traders are glued to their screens watching the dollar fluctuate, something far more sinister is unfolding in the shadows of global precious metals markets. For the next 8 days, the Shanghai Gold Exchange, the world's largest physical gold and silver trading hub, will go completely dark. Chinese New Year celebrations mean mainland markets are frozen, vaults are locked, and over 1.4 billion people are effectively removed from the global pricing mechanism. And in those 8 days of silence, Western institutions will do what they do best: manipulate prices with surgical precision while the world's largest physical buyer can't respond. This isn't speculation. This isn't conspiracy theory. This is documented market behavior that repeats itself every single year with clockwork accuracy. And if you're holding precious metals right now, you need to understand exactly what's coming. Because while Shanghai sleeps, COMEX wakes up with a vengeance, and the paper-silver market becomes a playground for institutional traders who know they have a temporary monopoly on price discovery. The pattern is so consistent, so predictable, that seasoned precious metals investors mark their calendars months in advance, preparing for what insiders call the Shanghai shutdown smash. Here's what most retail investors don't realize. The global precious metals market isn't one unified system. It's a fragmented battlefield where Eastern physical demand constantly clashes with Western paper manipulation. During normal market conditions, Shanghai acts as a counterbalance to COMEX's paper games. When Western banks try to suppress prices through naked short selling and derivative manipulation, Chinese buyers step in and drain physical supply, creating a floor under prices. It's a delicate equilibrium where paper meets physical, and neither side can completely dominate. But remove Shanghai from the equation for 8 consecutive days, and that equilibrium shatters completely. The mechanics are brutally simple. COMEX is a futures-based exchange where over 95% of contracts are settled in cash, not physical metal. It's a paper casino where banks can create unlimited synthetic supply through derivatives, options, and leveraged positions that have no connection whatsoever to actual bars sitting in vaults. Shanghai, by contrast, requires physical delivery. Every transaction on the Shanghai Gold Exchange must be backed by real metal in approved vaults. You can't print silver certificates in Shanghai. You either have the metal or you don't. This fundamental difference creates a natural tension where Shanghai's physical demand exposes COMEX's paper fraud on a daily basis. During regular trading, here's how the dynamic plays out. Western banks hammer COMEX futures with massive short positions during off hours when liquidity is thin. Prices drop artificially. Asian buyers wake up, see the discount, and immediately start pulling physical metal out of London and New York vaults for delivery to Shanghai. This physical drain forces Western institutions to cover their shorts or risk a delivery default. The price rebounds. The cycle repeats. It's a constant tug-of-war where paper manipulation gets checked by physical reality within 24 to 48 hours maximum. But when Shanghai goes offline for Chinese New Year, that checking mechanism vanishes completely. There's no physical buyer stepping in to call the bluff. There's no vault drainage forcing Western banks to cover. There's no Asian premium signaling that COMEX prices have disconnected from physical reality. For 8 glorious days, from the perspective of manipulators, they have free rein to engineer whatever price action serves their institutional positioning. And year after year, they use this window to execute the same playbook with devastating efficiency. The first phase typically begins 48 to 72 hours before Shanghai actually closes. Western institutions start building massive short positions in COMEX silver and gold futures, layering in downside bets while Chinese traders are still active but beginning to reduce their exposure ahead of the holiday. This is the setup phase. Think of it as loading the cannon before Shanghai's market closes and removes the only force capable of stopping the blast. The positioning is done carefully, quietly, through algorithmic trading that doesn't trigger obvious red flags in the commitment of traders' reports. Then, the moment Shanghai's last trading session ends and the closed for holiday sign goes up, the real manipulation begins. And what happens next isn't just price suppression. It's a coordinated psychological operation designed to shake out retail investors, trigger stop losses, and transfer wealth from unsuspecting holders into institutional hands. The manipulation playbook during Shanghai's shutdown operates on 3 distinct levels: technical, psychological, and structural. Let's break down exactly how Western institutions exploit this 8-day window, because understanding the mechanics is the only way to protect yourself from becoming exit liquidity for banks that have been running this scam for decades. Phase 1 kicks off within hours of Shanghai's closure, the algorithmic assault. COMEX floor traders unleash thousands of sell orders concentrated in the thinnest liquidity windows, typically Sunday evening futures opens and early Asian session hours when most Western traders are asleep. These aren't organic sells from investors deciding to liquidate positions. These are coordinated dumps of paper contracts designed specifically to create the visual appearance of collapsing demand. 5,000 contracts, 10,000 contracts, sometimes 20,000 silver futures contracts get dumped in spans of 15 to 30 minutes. The result is predictable. Price charts show dramatic red candles, technical support levels get violated, and automated trading systems start triggering cascading sell orders. Here's where it gets particularly insidious. Modern precious metals trading is dominated by algorithmic systems and retail platforms that use stop-loss orders as a safety mechanism. Investors set automatic sell triggers at specific price points to limit downside risk. But institutional traders know exactly where these stop clusters sit. They can see the order flow, they understand technical analysis patterns that retail traders follow, and they engineer price action specifically to trigger maximum stop-loss liquidation. It's a harvesting operation. They push prices down to 50-day moving averages, 200-day moving averages, key psychological levels like $30 for silver or $2,000 for gold, and watch as thousands of retail positions get automatically liquidated into their waiting buy orders. The beauty of the Shanghai shutdown window, from a manipulator's perspective, is that there's no Eastern buyer to absorb this engineered selling pressure and stabilize prices. During normal market conditions, when COMEX prices drop below Shanghai's physical premium, arbitrage traders immediately start buying COMEX contracts and pulling physical metal for delivery to China. This arbitrage activity creates a natural floor. Prices can only disconnect so far before physical demand equalizes the market. But with Shanghai closed, that arbitrage mechanism is completely offline. Western institutions can push paper prices down 5%, 8%, even 12% without facing any physical delivery consequences, because there's literally nobody on the other side demanding metal. The second phase of manipulation involves media coordination and narrative control. Pay attention during these Shanghai shutdown periods, and you'll notice a suspicious pattern. Suddenly, financial media outlets start running bearish precious metals stories with convenient timing. Federal Reserve signals strength in dollar policy. Inflation concerns ease as economic data stabilizes. Technical analysts predict further downside for gold and silver. These aren't coincidental editorial decisions. They're coordinated narrative placements designed to provide psychological cover for the engineered price drops. Retail investors see prices falling, read bearish headlines, and conclude that their precious metals thesis must be wrong. They sell, often at the exact bottom, transferring their positions to the same institutions that orchestrated both the price decline and the media narrative. Phase 3 is where the structural advantage becomes absolutely crystal clear: the derivatives manipulation through options expiration. COMEX precious metals options contracts typically have monthly expiration dates, and institutions specifically target Shanghai shutdown windows when major expiration events coincide with Chinese holidays. Here's how it works. Market makers sell massive amounts of call options to bullish retail traders betting on higher prices. These calls have strike prices at specific levels, say $32 for silver or $2,100 for gold. As expiration approaches, market makers have enormous financial incentive to keep prices below those strike prices, because if options expire worthless, they pocket the entire premium without having to deliver. During normal trading conditions, this manipulation is limited because Eastern physical buying can push prices higher regardless of paper games. But during Shanghai's closure, market makers have free rein to suppress prices below strike levels through coordinated futures selling, ensuring maximum options expiration profit with zero physical market resistance. The scale of wealth transfer during these windows is staggering. Billions of dollars in retail stop losses, options premiums, and forced liquidations flow directly into institutional accounts over the course of just 8 days. And the most frustrating part? It's completely legal. If you go back and chart precious metals prices during Chinese New Year periods over the past decade, the pattern becomes undeniable. Year after year, with statistical consistency that would make a Vegas casino jealous, silver and gold experience coordinated sell-offs during Shanghai's shutdown window. We're not talking about random volatility or natural market corrections. We're talking about systematic price suppression that follows the same technical playbook, hits the same liquidation levels, and reverses with almost mechanical precision once Shanghai reopens and physical buying resumes. Let's look at the forensic evidence. February 2024, Shanghai closed for Chinese New Year from February 10th through February 17th. During that exact 8-day window, silver dropped from $23.15 to $21.87, a decline of roughly 5.5% despite no fundamental change in supply-demand dynamics, monetary policy, or economic conditions. The selling pressure was concentrated in after-hours futures trading. Technical support levels were systematically violated, and retail sentiment indicators showed maximum pessimism right at the bottom. Then, within 72 hours of Shanghai's reopening on February 18th, silver rebounded to $23.40 as physical buying from China immediately absorbed the artificially suppressed prices. The same pattern played out in gold, down 3.8% during the shutdown, recovered within days of reopening. February 2023 showed identical behavior. Shanghai closed February 21st through February 27th. Silver fell from $24.50 to $23.10 during the closure, a 5.7% decline. Gold dropped from $1,950 to $1,793, a 2.9% pullback. Both metals reversed sharply the moment Shanghai resumed trading, and Chinese buyers started draining physical inventory from Western vaults. The selling pressure during the shutdown came almost exclusively from COMEX futures dumping in thin overnight markets, and the recovery was driven by Shanghai premiums, signaling that physical demand had never actually weakened. Only paper manipulation had created the illusion of selling pressure. Go back further. February 2022. Shanghai closed January 31st through February 6th. Silver declined 6.2% during that window. Gold fell 2.4%. Both reversed within 48 hours of Shanghai reopening. February 2021. Shanghai closed February 11th through February 17th. Silver dropped 8.1%, the largest Shanghai shutdown decline in recent history, falling from $27.50 to $25.28, before snapping back violently once Chinese buyers returned. February 2020. A 4.9% silver decline during shutdown, immediate recovery upon reopening. The pattern repeats with such consistency that you'd have to be deliberately ignorant to call it coincidence. But here's what separates sophisticated investors from retail victims: understanding that the pattern isn't just about price declines. It's about the specific technical and psychological mechanisms used to engineer those declines. Every single year, the playbook includes violation of the 50-day moving average, breakdown below round number psychological levels, and triggering of maximum stop-loss clusters. It's not random selling pressure. It's engineered liquidation designed to transfer positions from weak hands to strong hands at artificially suppressed prices. The institutions running this operation aren't stupid. They know that aware investors have caught on to the Shanghai shutdown pattern. So in recent years, they've added layers of misdirection. Sometimes the initial decline happens in the days before Shanghai closes, not after. Sometimes they execute a fake-out rally in the first 48 hours of closure to trap late buyers before the real smash begins. Sometimes they split the manipulation across two separate selling waves instead of one continuous drop. The surface tactics evolve, but the underlying strategy remains identical. Use Shanghai's absence to manipulate paper prices without facing physical market consequences. What makes this particularly insidious is that retail investors who recognize the pattern often still get trapped. They see the Shanghai shutdown approaching, they understand that prices typically get smashed, and they tell themselves they'll buy the dip. But when the actual decline happens, when they see their portfolio dropping 5% or 8% in a matter of days, when financial media is running bearish headlines, when technical charts are breaking support levels, the psychological pressure overwhelms their intellectual understanding. They capitulate at the bottom, selling their positions to the exact institutional traders who engineered the decline, and then watch in frustration as prices recover the moment Shanghai reopens. The question isn't whether the manipulation will happen this year. The question is whether you'll be prepared enough to avoid becoming the exit liquidity. So if the Shanghai shutdown manipulation is this predictable, this consistent, this brazenly obvious, why doesn't everyone just position themselves to profit from it? Why do retail investors keep falling for the same playbook year after year? The answer reveals something crucial about how institutional manipulation actually works. It's not about hiding the pattern. It's about creating psychological conditions where even investors who see the pattern can't execute the profitable response. First, understand that recognizing manipulation intellectually and acting against it emotionally are two completely different challenges. You can know with absolute certainty that prices are being artificially suppressed during Shanghai's closure. You can see the pattern in historical charts. You can understand the mechanics of futures dumping and stop-loss cascades. And you can still panic sell when the actual decline is happening in real time. Because manipulation doesn't just target prices, it targets human psychology. When your portfolio is bleeding red, when every financial outlet is running bearish headlines, when technical indicators are screaming sell, your primal risk avoidance instincts override your intellectual analysis. This is why institutions can run the same playbook repeatedly. They're not betting you won't see it. They're betting you won't have the emotional discipline to trade against it. The strategic response for sophisticated precious metals investors breaks down into three components: positioning, psychology, and execution. Let's start with positioning. If you understand that Shanghai shutdown periods consistently produce artificial price declines, the logical response is to reduce exposure before the closure and reaccumulate during the engineered dip. This means selling a portion of your holdings in the 5 to 10 days before Shanghai closes, holding cash or short-term treasuries during the manipulation window, and then aggressively buying physical metal or well-timed call options when the smash reaches maximum panic. The key is recognizing that you're not trading based on fundamentals. You're trading based on known manipulation patterns. But here's the trap. Most retail investors don't have the discipline to execute this strategy because it requires selling strength and buying weakness, which goes against every emotional instinct. When silver is holding steady at $30 in the week before Shanghai closes, selling feels premature. What if prices keep rising? When silver crashes to $27 during the shutdown and financial media is declaring the precious metals bull market dead, buying feels insane. What if it keeps falling? The institutional edge isn't information, it's emotional control. They can execute counterintuitive strategies because they're trading with algorithms and institutional capital. not personal savings and retirement accounts. Psychology is the second component, and this is where most investors fail even when they understand the manipulation. You have to develop what traders call divorced thinking, the ability to separate your analytical understanding from your emotional reactions. This means accepting that price declines during Shanghai shutdowns are not fundamental signals about precious metals' value. They're temporary technical manipulations in paper markets that have zero connection to actual supply-demand dynamics in physical metal. When COMEX silver drops 6% during the shutdown, that's not the market telling you silver demand is weakening. It's Western institutions exploiting a liquidity vacuum to engineer profitable price action. Train yourself to view these declines as buying opportunities, not portfolio catastrophes. Execution is the final piece, and this is where physical precious metals investors have a massive advantage over paper traders. If you're holding physical silver and gold in your possession, Shanghai shutdown manipulations are completely irrelevant to your long-term thesis. You're not forced to sell, you're not getting margin called, you're not facing counterparty risk or delivery failures. You can simply ignore the paper price theatrics and wait for Shanghai to reopen and physical demand to reassert itself. In fact, if you have available capital, these windows present some of the best buying opportunities of the entire year because you're purchasing real metal at artificially discounted prices created by paper manipulation that can't sustain itself once Eastern physical buyers return. The ultimate irony of the Shanghai shutdown manipulation is that it's a self-defeating strategy in the long run. Every artificial price suppression creates pent-up physical demand that explodes the moment Shanghai reopens. Every engineered decline transfers metal from weak Western paper hands to strong Eastern physical hands. Every year, this pattern drains more physical inventory from COMEX and LBMA vaults into Chinese and Asian reserves. The institutions running this manipulation are executing a tactical victory that accelerates their strategic defeat. And when the physical market finally overwhelms the paper manipulation completely, that 8-day window they've exploited for years will become their worst nightmare.